The World Economic Forum promotes CBDCs as a path to greater financial inclusion, suggesting these digital currencies can combine the best features of cash, digital payments, and crypto. But what does inclusion really mean when it comes at the cost of constant oversight? At a WEF meeting, Cornell professor Eswar Prasad warned that programmable CBDCs could allow governments to set expiry dates on money and block purchases they consider undesirable. Everything from ammunition to certain online content. This isn't just a theory. China's digital yuan already restricts specific transactions. As more countries test these systems, the line between convenience and surveillance blurs. The WEF's language around efficiency and inclusion deserves closer scrutiny, because the terms themselves may signal a much broader shift in how every financial decision is tracked and controlled. Financial inclusion is presented as a universal good, but the WEF's documents show it's more than just a catchphrase. Their version of inclusion depends on embedding full-spectrum tracking into the financial system. With CBDCs, every transaction is logged and permanently accessible to authorities. This isn't a side effect, it's the foundation. The WEF's Central Bank Digital Currency Policymaker Toolkit promotes inclusion while specifying the infrastructure needed for detailed transaction monitoring. These aren't two separate goals. Monitoring is the mechanism that enables inclusion as defined by these new systems. Christine Lagarde, head of the European Central Bank, put it bluntly: digital currency will never offer the privacy of cash. The bargain is clear. Access comes with the loss of financial anonymity. Programmability is where the language of inclusion becomes a tool for control. Policymakers refer to targeted policy functions, technical jargon for rules that dictate how you spend your money. Eswar Prasad at a WEF event highlighted the risk. Governments could restrict purchases of anything from ammunition to online content. Russia's central bank has already floated the idea of blocking digital rubles from buying junk food. These aren't just theoretical examples. They reveal a shift in the role of money, from neutral medium to instrument of policy enforcement. This contradiction is hard to ignore. Systems promoted as empowering individuals are, by design, centralizing control. Financial inclusion, in practice, often means financial supervision, dressed up in positive language. The pattern isn't new. History is full of financial systems that promised stability or access, but delivered central oversight. The difference now is the technical capacity for granular, real-time control. The technical architecture makes this possible. Unlike cash, which leaves no digital record, CBDC transactions generate immutable trails. Programmability lets authorities attach rules directly to the money itself, something that can't be done with physical currency. These aren't accidental features. They're built in from the start. The Bank of Amsterdam's experience in the 17th century is a reminder that even well-intentioned systems can be abused if governance fails. Today's digital systems have far more reach, and the push to retire cash, described as antiquated by Bahrain's central bank governor, shows how privacy is being redefined as a problem to solve, not a value to protect. The real issue is the language used to sell these changes. Inclusion means oversight. Efficiency means control. Digital convenience is traded for autonomy. These aren't distant possibilities. Technical papers and pilot programs confirm that the capabilities already exist. China's digital yuan restricts purchases in practice. European pilots are testing expiry dates and transaction limits. The tools for financial control are operational, not hypothetical. What makes this shift important isn't just the technology, it's how the reality is masked by strategic terms. When officials talk about modernizing financial markets, they're describing systems that could block your transactions according to government policy. The same documents that highlight inclusion also lay out surveillance infrastructure. This gap between the public narrative and technical reality is what demands attention. Because once these systems are in place, changing direction is far from simple. All of this sets the stage for what programmable money looks like in practice. Programmable money is already shaping how financial systems operate. Eswar Prasad's warnings about currency expiration dates and spending restrictions are reflected in live CBDC projects. China's digital yuan is a working example. It blocks purchases of specific goods like cigarettes and gambling services, demonstrating the ability to enforce policy through the currency itself. The European Central Bank's digital euro pilot tests transaction caps and expiry dates, meaning the money in your account could be set to vanish if not used within a certain time frame. These are not hypothetical features. They're being tested and implemented now. The core mechanism behind programmability is twofold. First, automated payments can be executed through smart contracts, releasing funds only when predefined conditions are met. Second, and more critically, spending restrictions can be embedded directly into the digital currency. Central bank technical papers describe how CBDCs can enforce government policy without new laws. The Bank of Russia, for example, details special conditions attached to digital rubles, controlling both how and where they can be spent. This shifts enforcement from the legal system to the monetary system, bypassing the usual democratic checks. Historically, money acted as a neutral tool. You decided how to use it. Programmable money reverses that relationship. When China's digital yuan blocks certain categories of purchases, or when the ECB experiments with expiry dates, the currency itself becomes an instrument of policy enforcement. The technical design ensures these controls are not just possible, but easy to implement. Once in place, changing the rules becomes a matter of software updates, not public debate. This approach sidesteps traditional oversight. Instead of passing legislation, central banks or governments can encode rules directly into the system. Russia's deputy central bank governor made this clear. We can program the money to ensure it's spent on what it's needed for. That could mean limiting digital rubles to groceries or restricting spending to approved vendors. The ECB's transaction limits serve a similar function, controlling not just what you can buy, but how much. These features are operational. In Shenzhen, China's digital yuan trials blocked alcohol and tobacco purchases. Nigeria's e-Naira restricts peer-to-peer transfers to curb illegal flows. The Bank of England acknowledges that CBDCs could apply positive or negative interest rates at the individual level. Each example illustrates how programmability is not an add-on, it's central to the system's design. The real impact emerges when these features align with broader policy objectives. Expiry dates encourage spending during downturns, while category-based restrictions enable mass behavioral nudges. These technical tools fit seamlessly with institutional goals like modernizing financial markets and implementing stakeholder capitalism. The money itself becomes a lever for shaping economic behavior at scale. What's at stake is the underlying power dynamic. Physical cash exists outside of central control once withdrawn. Programmable digital currency, by contrast, never leaves the system's reach. Its restrictions travel with it, fundamentally altering the relationship between individuals and their money. When every transaction is subject to policy-defined conditions, money is no longer just a medium of exchange. It's a mechanism for compliance. Understanding how programmable money operates makes it clear why these systems are being prioritized by global institutions. The next step is to examine how these technical capabilities fit into broader economic and social agendas. The World Economic Forum's Great Reset initiative is closely intertwined with the global rollout of CBDCs. Their Modernizing Financial Markets report positions digital currencies as the backbone of stakeholder capitalism, framing programmable money as a necessary foundation for large-scale economic restructuring. This is not a coincidence. The technical features of CBDC's real-time tracking, programmable restrictions, and automated policy enforcement align directly with the WEF's goals for resource redistribution and systemic control. CBDCs solve a fundamental challenge for resource management schemes. They make every transaction traceable. This complete visibility is central to the WEF's vision of equitable distribution of resources. Digital currencies enable authorities to monitor private wealth and spending patterns at a granular level, something cash never allowed. In practice, this means programmable money could enforce savings caps, spending quotas, or direct redistribution at the individual level, all managed by code rather than legislation. The organizational partnerships reinforce this direction. The Bank for International Settlements Innovation Hub and WEF-affiliated corporations are working together on CBDC infrastructure, establishing global standards for programmable digital money. These collaborations lay the groundwork for systems where access to financial services is conditional. The architecture behind China's social credit system is an early example. Access to resources is determined by compliance. CBDCs provide the infrastructure to replicate this model, adapted to local contexts and policy objectives. The ability to program money for policy enforcement is central to the Great Reset agenda. The WEF's reports describe tools for shaping consumption patterns, and programmable digital currencies make this possible at scale. Governments can set rules that block certain purchases, whether related to health, environment, or politics, turning money into a tool for behavior modification. The European Central Bank's experiments with green transaction limits are a practical demonstration of how monetary policy and social objectives merge. Cash stands as the last barrier to this level of oversight. WEF documents and statements from central bank officials describe physical money as outdated, advocating for digital alternatives that offer no offline privacy. Countries like Sweden and Nigeria are moving to restrict cash, while the EU advances its digital euro proposal. Technical reports acknowledge that CBDCs require giving up cash-level privacy, finalizing the surveillance infrastructure. What emerges is a system where financial access is tied to compliance with programmed rules, and alternatives are systematically removed. The WEF's own materials discuss the transition to new forms of value exchange, where programmable money replaces the neutrality of cash. This shift changes the basic relationship between citizens and economic participation. As these changes accelerate, the debate over the role of physical cash becomes more urgent. Across central banks and policy circles, the push to eliminate cash is gaining momentum. At a recent World Economic Forum meeting, the Central Bank of Bahrain's governor described physical currency as antiquated, echoing a broader consensus among financial leaders. The rationale is straightforward. Cash is the last form of money that doesn't automatically generate a surveillance record. For those designing programmable digital systems, removing cash is essential to achieving total visibility over economic activity. The pandemic accelerated this agenda. As digital payments became the default in the name of public health, central banks noted how quickly people adapted to a cashless environment. What began as a temporary measure became a permanent behavioral shift. Now, with CBDCs on the horizon, central banks are using this momentum to justify phasing out physical currency entirely. Reports from the European Data Protection Supervisor confirm that CBDCs, by design, require giving up the privacy that cash once offered. In account-based digital systems, every transaction is linked to a verified identity, creating a permanent, centralized record. This shift is not just about convenience. Eliminating cash completes the infrastructure for comprehensive financial monitoring. Once physical alternatives disappear, every transaction becomes trackable by default, and the option to operate outside institutional oversight vanishes. History shows that regimes seeking control often target financial privacy first, whether through restrictions on gold, as in 20th century Germany, or through modern systems like China's social credit apparatus. The pattern is clear. Control over money precedes control over behavior. Central banks frame this transition as inevitable modernization, with officials like Bahrain's governor predicting a fully digital system and dismissing concerns about privacy or autonomy. Technical documents present the shift as a neutral upgrade, but the underlying functionality reveals a different reality. Digital systems create immutable audit trails, and programmable features allow authorities to enforce rules directly through the currency, whether for tax enforcement, spending limits, or policy compliance. Without cash, opting out of this system is no longer possible. What makes this transition so significant is the change in power dynamics. Cash, once withdrawn, operates outside institutional reach. Digital money, by contrast, remains within networks where access can be modified or revoked at any time. The system moves from one that presumes individual autonomy to one where oversight is the default. This is not just a technological evolution. It's a structural transformation of how financial freedom is defined. As cash access points dwindle and digital systems become the norm, each step toward a cashless society makes programmable money more entrenched. Technical reports admit that sacrificing cash-level privacy is a necessary trade-off for CBDC functionality. The gradual disappearance of physical currency removes alternatives, making the transition to fully monitored, programmable systems almost irreversible. Faced with this trajectory, The question becomes how individuals can respond strategically. Defensive strategies start with understanding that the system's effectiveness depends on near-universal participation. Maintaining assets outside purely digital formats introduces obstacles that slow or complicate centralized oversight. Physical assets, precious metals, collectibles, or real property exist beyond the reach of digital tracking. These aren't just stores of value. They become practical alternatives if digital transactions face restrictions or monitoring. Decentralized cryptocurrencies can also serve as hedges, but only when self-custodied. If crypto remains on exchanges, it's subject to the same vulnerabilities as CBDCs. Genuine alternatives require direct control, privacy coins, Layer 2 solutions, and secure wallets. Even Bitcoin's open ledger presents privacy risks, so learning privacy-preserving techniques like CoinJoin or using the Lightning Network is increasingly important. Cash remains a critical buffer. Physical notes and coins enable anonymous exchange and create gaps in the surveillance net. Prepaid cards purchased with cash, local barter arrangements, and in-person transactions all reduce digital footprints. For digital payments that can't be avoided, compartmentalizing financial activity, spreading transactions across multiple accounts or using intermediary services limits the exposure of any single profile. The priority shifts from maximizing convenience to maximizing autonomy. Each financial interaction requires asking, does this need to be tracked? Local cash purchases, peer-to-peer exchanges, and physical asset transfers regain value as tools for privacy rather than nostalgia. The more that occurs outside the digital sphere, the less complete any surveillance system becomes. Asset allocation takes on a new meaning, diversifying into physical precious metals, holding decentralized crypto in private wallets, and keeping a reserve of cash, all serve to reduce dependence on any one system. Geographic diversification, spreading assets across different jurisdictions, adds another layer of resilience. If restrictions emerge in one country, access may still be possible elsewhere. Technical literacy is now a practical necessity. Knowing how to set up secure wallets, use privacy-preserving payment methods, and recognize surveillance-resistant tools is no longer optional. Each skill increases the friction for centralized monitoring and builds personal resilience. Fragmenting payment methods is another effective approach, using cash for some transactions, prepaid cards for others, and crypto for specific purchases creates disconnected data points. This makes comprehensive profiling more difficult and mirrors operational security principles applied to personal finance. No single tactic is sufficient. The most robust defense combines physical assets, privacy coins, and cash, creating overlapping barriers to centralized oversight. The objective isn't to avoid digital systems entirely, but to prevent absolute reliance on them. Every alternative, no matter how small, adds friction to the system's ability to monitor and control. As programmable money becomes more entrenched, these strategies gain urgency. The systems under discussion are designed for near-total adoption, but even partial opt-outs weaken their reach. Strategic resistance isn't about escaping oversight completely, but about ensuring that no system achieves perfect control. This sets the stage for the broader public debates and policy battles that will determine the future boundaries of privacy and financial autonomy. Legislative and technical decisions around CBDCs are converging on two main battlegrounds: access to physical cash and the definition of privacy within digital systems. Lawmakers are debating whether to enshrine cash as a legally protected alternative, recognizing its role as the last widespread means of anonymous exchange. Ori Freeman's policy recommendations underscore this, framing cash not as a relic, but as a necessary safeguard for financial privacy in a digital age. The technical architecture of CBDCs is still in flux, allowing for a range of outcomes. Central banks can design systems that prioritize surveillance or, with enough pressure, introduce privacy-preserving features. The crucial debates focus on default settings, whether privacy is the norm or requires extra steps to activate. The European Central Bank's consultation process revealed that public demand for cash-like anonymity is significant, and central banks have already adjusted some technical proposals in response. These moments show that public engagement can steer the direction of CBDC design, but only if sustained and informed. Pushback has already altered the trajectory of several rollouts. Nigeria's experience with the e-naira showed that restricting cash can provoke resistance, ultimately forcing governments to reconsider their strategies. In Sweden, rural communities' demands for cash access delayed the shift to a fully digital system. These examples make it clear that implementation timelines are not set in stone. They respond to organized opposition and practical realities on the ground. Commercial banks add another layer to the conflict. While central banks issue CBDCs, commercial banks often control the user interface and programmability features. Their willingness or reluctance to implement restrictive functions could significantly impact how much control governments can exert. The Bank of England notes that commercial banks may resist features that alienate customers, creating a subtle but important counterweight to policy ambitions. Technical design choices remain open for now. Some prototypes, like the digital euro's value-based option, allow for small offline transactions that mimic the anonymity of cash. These features are not yet locked in, making this phase critical for those who care about privacy and autonomy. Once the systems are operational, making fundamental changes becomes far more difficult and costly. Payment infrastructure is also becoming a site of contest. Legal requirements for merchants to accept cash are under debate in many countries. Germany has strengthened such protections, while other nations see businesses phasing out cash entirely. These local decisions collectively influence whether digital payments remain a choice or become a mandate. Another technical front is interoperability. Closed systems, such as China's digital yuan, maximize issuer control, while open architectures, like the Bahamas' sand dollar, permit some integration with third-party wallets and privacy tools. The degree of openness will dictate whether meaningful alternatives can coexist within the digital ecosystem. Legal challenges are beginning to test the boundaries of programmability. Proposals to allow blocking functions in digital euros have sparked legal and public debate about what constitutes legitimate restrictions. Recent court cases on cash access, such as those in Australia, signal that judicial systems may play a decisive role in determining financial autonomy. Right now, the window for shaping these systems remains open. Public comments, legislative advocacy, and commercial bank preferences all serve as leverage points. The technical frameworks being finalized can support either open, privacy-respecting systems or tightly controlled infrastructures. Which path prevails will depend on who shows up and what arguments carry weight during this crucial period. As these debates intensify, the nature of financial governance is being redefined in real time. At the core, CBDCs are not just updated payment rails. They represent an overhaul of financial governance. Programmable features shift the balance of power, allowing policy to be enforced directly through the money itself. The real question isn't whether money is digital or physical, but whether the system protects autonomy or enables granular control. China's spending blocks and Europe's digital expiry dates show these capabilities are already active. Preparation matters now, before adoption becomes universal. Physical assets remain outside digital tracking. Using privacy tools helps preserve transactional anonymity. The window to build and maintain alternatives is open, but shrinking. Financial systems reflect underlying power. Diversifying today preserves options tomorrow.